Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming in YouTube here. We have a typical month-end sell-off obviously happening here. As you can see, gold down about $26, $27. Silver down about 38 cents, 38 and a half cents. And this is the typical sell-off that we see here every month as the options expiration expires, and there is a basically application of large short sellers that essentially come into the market, into the futures market, into the paper market, and take out all the stops and basically bring down the market below the strike price at expiration in order to keep the premium, basically. So every month what you'll see here is an attack of the short sellers into expiration of the contract. And if we can take a look at what's going on here today, a couple of things are going on in terms of the economics of the market or the fundamentals of the market. Inflation is persistent, continues to be persistent, and consumer spending is at a much, much higher level than anticipated. U.S. consumer spending rises solidly in September. Inflation stays high. U.S. consumer spending increased solidly in September. But was flattered by higher partly flattered by higher prices as inflation remained hot and shortages of motor vehicles and other goods in the face of global supply constraints. Economists polled by Reuters had forecasted consumer spending increasing 0.5%. Resurgent in COVID-19 cases over summer, driving by the Delta variant, worsened work shortages of factories, miners, and ports, further stressing supply chains. Outside the shutdown in the spring 2020, which severely depressed output, the third quarter was the worst period for motor vehicle production since early 2000 because of the global shortage of semiconductors. Now, we seem to be experiencing shortages of just about everything across the economy. And it is causing a short-term bottleneck that we're dealing with right now, that's causing basically prices to increase tremendously. And the gold market here, obviously, being affected short-term by this sellers, obviously, that feels at the end of the month, this is the application in terms of the options expiration. But when you take a look at the fundamentals, if inflation is running hotter than everybody was expecting, why is gold down? Why do they, hit the market in gold and silver the way they do? It's an artificial play that essentially will be adjusted. And if we take a look away from basically the fundamentals, which are skewed. The market is not reacting to the fundamentals. The gold and silver market are completely the opposite. And this is one of the most frustrating things about being bulls in the gold market here, that we have the biggest, most bullish fundamentals ever that we've seen. We've never had this record debt. We've never been in negative interest rates. And inflation is very similar to the 70s. The only difference is that in the 70s, we didn't have this kind of debt. And so we're looking at an exponential, I would say, level of volatility that we're going to see as the gold and silver market will adjust itself in the monetary system. It's been completely ignored. It's been completely put aside, so to speak, against digital assets, against Bitcoin. And we're coming to a point where we're going to realize what is real money. And I know there is a lot of discussions going on in terms of Bitcoin becoming the world's currency. And yes, it is, and it has become an asset, a digital asset that we have to deal with. But it's not going to take the place of gold and silver. Nothing will ever take the place of gold and silver. Particularly if we move into a digital world of gold and silver. Particularly if we move into a digital currency of some kind that will be backed by gold and silver. Which is where I think we're moving into. Otherwise, all these other dimensions of monetary assets or currencies are simply the same as a regular fiat currency, which has no backing. The value that is being given to Bitcoin, obviously, is the blockchain technology, which is making it completely decentralized from the banking system. So that is basically the element that I believe is going to maintain Bitcoin as a digital asset in a digital world. If we move into the market right now, we can see the price sell-off moved into an area of blue, pretty much, that is recommending this is the area to accumulate. This is the area to accumulate. If you've been expecting this correction, and this is where you want to cover any short hedges that you have. You want to cover any short positions that you have, particularly for my traders in my trading room. I think the drill, you know the drill here, that we got to cover shorts, cover short calls, cover any short strategies that you have. And this is where we want to get on the long side of the market. Let's watch the market here for a little bit. Silver is getting a major support from these levels here. Major reversion going on, particularly from the buy 2 weekly level. And if you're not long the market here, this is a great time to be entering longs. As I said, the volatility is high in terms of the futures right now, as you can see. So this is a great time to be buying assets, to be buying derivatives in the gold market, as I feel that we have come down and have completed the correction. And what you see here basically is the reversion unfolding of solid buying power that has taken all the supply pressure that we have seen here since the market came down below the average prices. It went up into the average price, completed the target from the signal at 1 a.m. The target was the mean. It reverted and completed the targets below of buy 1 and buy 2. And now the market has reverted right back up again above the buy 2 level, which is 23.86. And it's recommending to go long. And so we're in fast market conditions, and I think that this is where you got to get on the long side. Add to your long positions in derivative assets. What you're seeing here is the sell-offs that we have in the market are not lasting. They don't last, and that means that the selling pressure basically is losing the momentum. And we continue to see the markets being supported here. A close above 1780.83 is going to activate the buy 2 level weekly. And if we activate the signal here on the buy 2 level of 1783, it's going to give us about a 95% probability that we could see the market revert back to the mean above 1802. The weekly mean is 1790. If we get above 1790, it's going to activate the 1819 target. So let's just watch the market here for a little bit.
I've never felt so close to the possibility of disclosure. The Nephilim.
We need for the market to get back above 1783 to get on the low side. Silver has activated a buy signal from 2386. The close on this bar is the conservative signal to go long. For those aggressive traders that essentially, there's two types of traders, aggressive and conservative. I would say, not necessarily traders, but I would say strategy. And there are some obviously more conservative traders than aggressive traders. But in terms of a strategy, the most conservative strategy the VCPI recommends is a close above the pivot point would activate a buy trigger on the 15-minute bar. The first bar here activated a shift in the momentum, and this was a basically bullish pattern unfolding, and it tells you prepare. If you're aggressive on the next bar, you can buy at the market, or you can wait for the close conservatively to get long. So let's wait till the close and follow the conservative approach. But the conditions of the market always dictates, what action to take. And so if you're doing multiple positions, for example, you can buy one at the market, and use the 2386 close below as your protective level. If the market closes below 2386, you can get out, and you don't act on the long position. You go neutral. But if it closes above 2386, I want to get long, and you can add a second position at that point. We're getting a clear signal right now in silver, so we're going to focus on the silver market. And wait for the gold market to give us an activation above in order for us to add to our positions. A close above 1783 is a buy trigger for the gold market. The variable change in price momentum indicator gives you three choices of stops. The first one is the conservative stop, which is a close below at the close of the 15-minute bar. The second stop basically is what I call a dollar amount, a catastrophe stop dollar amount that you as an individual trader is comfortable to risk. And if you're a multiple player, multiple size player, when you're at buy 2, you can actually wait until the close of the day to take that risk. because from a mathematical probability model, what the algorithm is telling us here is that when the price is at B2, it is the highest mathematical probability of a reversion unfolding. And of course, if we look at the cycles here, it looks like we're getting some kind of a bottom, also confirming by our cycle. And right now, I'm simply using the pivot points, and I'm using the logic of the algorithm, which was written in C++, that essentially activates this pivot points and transforms them into a mathematical probability with a very specific excuse me entry point, exit point, and target. 7:22, and we have another few minutes, obviously, until the close. Obviously, we have a lot of red here this morning in assets here, in metals. The digital markets are quiet this morning. Bitcoin is fairly quiet this morning. Trading in a range of the daily average and the weekly average, so it's in a neutral zone. And one of the comments here that I want to make, and I want to alert you here, is that we are going to be getting potentially food shortages as these markets in grains now have reverted, particularly corn, for example. We want to pay attention to the corn market, and you can take this market and you can take advantage of this market in different ways. You can trade the futures, you can trade spreads, you can trade options, you can buy shares. Corn shares is a very good way of trading the market from a share point of view, more conservative approach. But we are breaking out, and we expect that we're going to be coming into a major shortage of food here. We have obviously a bottleneck of supplies. Ships are not moving fast enough in delivering the goods, and these are durable goods. So as we move into harvesting time and the grain season pretty much is harvested here, I question seriously if we can get durable goods delivered in time. How are we going to get food delivered in time, particularly when it's perishable? So what I'm hearing is that the government is paying farmers in certain crops to destroy their crops because they can't get it into the market fast enough. So we have a kind of a really serious bottleneck situation here that I believe is going to be exasperated by the amount of basically limited labor that we have. Truckers are being offered $100,000 a year. So it's labor is in demand, and that is an inflationary sign. And obviously, we want to see how much this inflation spills into the retail end of the business, and see how high, grain prices pretty much across the board are going to rise. Coming back to the gold market here, once again, I want to point out that the gold in the silver market are monetary assets that are lagging the intermarket relationship in value. If you just compare it to crude oil, I keep pointing out crude oil is $85 a barrel, moving towards 100, and the gold market is in the 1775. When you take a look at the economics of the relationship of gold to even the stock market, to the S&P, it is at a historical divergence. And this feels very much like we're back into that 70s kind of environment regarding inflation. The difference again is that we have interest rates at negative rates, and we have a record level of debt that potentially is reaching $30 trillion. So to all my traders, to all my subscribers, I think the one thing I can say is be patient. I think we have a great opportunity right here. Once again, every time it comes down into these levels, to add to your position, to cover again any short hedges that you might have, and prepare to get on the low side. We are at the extreme below the mean. And with this kind of fundamentals, I just think it's a matter of time before things begin to adjust to the mean. And if the gold market will adjust to the mean, and we really, we're looking at the mean into that 1840, about $100 higher from here. The silver market is like a pressure cooker that I believe will far, far exceed the volatility that we're going to see in the gold market. So be patient, my friends. Accumulate at these levels here. And in the meantime, have a great, great weekend. Be safe. I'll talk to you soon.